So Patrick, tell me what a hard money loan is.
Well, a hard money loan comes under many different names, but it's known by things like bridge lending, it's going to be high interest loan, it's going to be hard money loan. And what those loans are is that typical someone is going to come out and it's all going to signify that it's asset based versus credit based. So a credit based loan is going to be, let's just say that you want to go out and buy a car that is, say, from the 1920s. Well, typical banks will loan money on things that are cars maybe up to 10 years old. But we all know that a classic car is going to have a lot of value, but the bank has no way of figuring out what that value is. So they would make a loan based on what your credit is or what your background is or how much money you generate. A hard money loan doesn't take that into consideration. We only look at the things that are assets. So the asset of what you want to borrow on, and we make the real estate equivalent of the old car, so to speak, is a piece of land that has a house on it or has a apartment complex or other commercial property. We know what that property value is as it sits, and we understand what it's going to be when it gets repaired or when it gets fixed or when you get long-term financing on it. So we don't have the same parameters that a bank does. We don't have all the red tape that a bank has. We don't have all of the time that it takes. A typical loan for us is 2 weeks versus 60 to 90 days. And we don't have all those requirements on what your background and credit is. If it's a good risk for us based on the asset, that's what we're going to do. So the reason that it's called hard money is that it's money that is not, banks will loan money, no problem, but they do things that are not looking at what the asset is the way that we do. So that kind of came up with a hard money description.
Got it. Thank you for your help.
You're welcome.